Good morning, everyone, and time to go over the daily plan again. Today, the 23rd, Tuesday, 23rd of December, one day away from the holiday shortened trading Wednesday, and more or less the kickoff of the Santa Claus rally, depending on which guru nuance you want to look at for when the rally starts. But anyway, here we are. So yesterday, just a quick recap of yesterday. And we closed on Friday at around 68, 40, really 68, 38-ish for who's counting. And just as a reminder, in case your PTSD has caused you to forget what happened last week, we kind of had that big falling apart week where we tested the 6,700 level. Friday, we kind of regained our footing. Friday was OPEX day. After the options expiration, we opened right at 6790-ish, 89. I had said looked like it was going to be 90. And once we got over 6,800, was a whole change in complexion of the market. And we went into options expiration. Overnight on Sunday, we kind of gapped up, and here we are. So we've been in a narrow range. And the VIX tells us we've been in a narrow range, or it's predicting we'll continue to be in a narrow range. Okay, so some of you may notice these little whales here. I can make them bigger if you like. So these little whales represent the IC whale. And for those of you that aren't familiar, although if you've been listening to me or following me or following this general space, you probably are, otherwise called Captain Condor by some. I claim the name IC whale because I spotted him first. So anyway, that said, so the IC whale is back today with roughly 40,000 contracts, greater than 40,000 of call credit spreads and put credit spreads on Condor. And we'll talk about it a little more granularly later in the discussion here. Brief overview, though, of his methodology. Simplified version is if we have 2 days in a row where realized volatility exceeds implied volatility, he starts selling 5 wide iron condors at about a 20 delta. I'll talk a little more slowly. Around a 20 delta for roughly a third the width of the spread or more, so 5 wide, 165, 170, or up to $2. If he loses, which he often does, especially on the first and second round, he increases his size, roughly doubling or more, following a variation of a martingale progression until he either goes broke or until he's either all in and goes broke, but that hasn't happened yet. I'm not wishing it on him, I'm just saying. So now he's at 40,000 contracts. So if he gets skewered today, gets harpooned, then he comes back pretty much for the final load of all in, go broke or go home on Wednesday. He's actually been more aggressive than usual in terms of the premium collected and the strike selection, but that's again kind of in the, there is a little bit of leeway in what he does. So anyway, so he's back here with this big size, which basically caps the range of the day or defines the edges. Now, wait a minute, Doc. Wasn't he there on Monday? Yes, he was. And he was at 68.50-ish or 60, I forget exactly where. Once we gapped above his call credit spread at the time, that became a floor. And so support resistance 101, resistance over resistance had become support. That's kind of ish what happened. And then that was it. So he provided a nice floor. And here we are. Well, that might have been the day before. I forget. Yeah, that was yesterday. And now here we are. And so we're down a little bit from the close. We've got these two levels over here at 55 and at 6,900. Mentally think 50, 60, think 6850, 6,900 round numbers. So we, in theory, shouldn't go below those. Although I think the muted volatility and the seasonality says, yeah. However, Gamma says if there's risk, it's probably to the downside. We're going to look at that in a minute. Okay, so where are we? Santa rally mode, we grinded higher, 0.6%. Okay, let's talk about vol for a second. Vol is a tell. We have VIX around 14, VIX 9-day around 10.5, VIX 1-day, which I think sucks as a measure. I just put it in there for fun. I think it's close to useless. So that gives us, if you look at like just the expected move priced in based on the vols, it's, I have it, so 30-point day today, and then 40 something points, and then 60 points if you go to the 9-day and to the regular 1 month VIX. So expected moves are kind of widening. The options market is saying we should be muted for the next week. The VIX 9-day of 10 is about a 0.6% move a day. Thought I had it in here. I probably do somewhere else. I have it in a different part. Here's the IC whale. We already talked about him. This is what my daily plan. This is what you get when you subscribe. Only you can scroll as slow as you want. We have GDP and all this stuff. We have some numbers at 8:30. So who knows? Maybe the market's saying they don't care. So we'll see if they care when they come out. Industrial production, capacity utilization, more numbers. And then we have consumer confidence coming up. And that's pretty much the last of the numbers for the year. We have bullshit earnings, look, a couple little companies, that's a technical term. Honeywell reported and was down when I looked. I like the company as a longer term hold trade, not investment advice. When I looked at the story, was basically there was a lawsuit. I don't really care what the suit was about, and they settled and they did a write down, and so they're earning. And because of that write down, it's not really affecting anything, but the market, you know how it is, sell first and ask questions later. And it's down 1 or 2%. It's not a huge drop. Okay. And here's the levels for today based on the expected move. I'm not going to bore you with that. I'm going to show you this. This is from options desk. People get that little, great. I don't know how to get rid of that. Oh, I see. I go back somewhere. Remind yourself, don't do that again. Here we go. No, here we are. I have no idea how to get back to where I was. So that's the end of looking at my daily plan. Wait, here it is. Here it is. I'm not.
So real quick, Doc, maybe just take a quick minute. What you're scrolling through is the plan that's available on Substack. And that is, how does that relate to your Discord?
Okay, so good question. And also, by the way, glad you mentioned it. WHOP, WAP, and Substack get the same content. The same thing goes to both places. So in the Discord, this will be in the Discord, as well as me talking about it during the day, intraday, as we're moving, me screen sharing, me discussing it. People ask questions. Oh, what about this? What about that? People put in comments. Little artwork like this, which I'm not going to dare click on again, or else I'll get lost again. Little things like this, thrown in there in my commentary section with observations, whatever. And so it's all this and more. And plus the community, there's a community. And plus we also have I'd have to get somebody in there. Dan, who some of you may know from other services, does our volatility related trades, earnings trades. We have somebody, JD, who's also really good with scalping kind of trades in, calls or puts. We have unusual whale spots. So we have educational content that I throw in there. So there's a wide umbrella. Sometimes it's like drinking from a fire hose. There's a lot of stuff there. So just kind of take your time. Some casual weekend on the reading on the weekends. Oh yeah, so here's
they've been doing really well. Dan and JD, the two that you just mentioned, they're on Doc's alt trades on his Discord, and they post some interesting stuff there. But here recently, especially with the day we had yesterday, I know JD was doing some gold trades. It's a GM swing, I think it's what you're looking at right now. So if you're looking for stock ideas as well as premium selling and futures, Bad Hombre hosts the futures channel on Doc's Discord. So a little something for everybody.
Right. And so this is Dan's trades are more volatility based, realized vol versus expected vol, and they're going to be earnings trades. Here's another one of Dan's trades. And so, there's a little something for everybody. I'm mostly SPX, although I do a lot of this stuff too on the side, so to speak. And I do mostly iron conduits, as most of you know, butterfly, some directional stuff. I feel I'm more accurate with a hand grenade than with a sniper rifle. And so I could say kind of where it's not going pretty good. And the intraday scalps tend to work. For whatever reason, I prefer to just sell premium in my old age. The excitement of watching the trade play out is kind of, the thrill is gone with that for me. I used to like it a lot more. Okay, and happy holiday to everyone. And so here we are. I'm going to put Vol Trader on, who used to make markets in Europe before he does what he does now, which is kind of hang out and consult and trade and hang out with me. So go ahead, Val, if you have something you want to share with us.
Yeah, hi. Good morning. I don't know who was listening yesterday. I came up with some insights on the QQQ. We'll call it NASDAQ. Doesn't matter if the QQQ, NQ future, or the NDX index. We'll just call it NASDAQ. The reason for that, I was looking elsewhere from the SPX, is because obviously these iron condors have a specific and unique effect on the total US market, which is kind of crazy that one specific group of individuals publicly share their position, and it overwhelms everything else. So I'm trying to look elsewhere and find some insight there. So yesterday, I identified a major cluster of in-the-money calls on the Qs, on the QQQ, that were closed Friday, and I came with a bearish.
You have your excuse me. You have your little screen.
Yeah, I'll show everything. And I came out with a bearish note on the NASDAQ, which turned out to be basically the market that also affected the SPX.
Quick disclaimer: this is Spot Gamma's QQQ stuff. I don't have my own, and I have other stuff available. So, Spot Gamma, thank you, Brent. This is your stuff. Luck for Spot Gamma. Go ahead.
Now today also the Qs are expressing a very unique configuration through the analysis. So I'll walk us through that. I'll start with some pieces of information regarding the SPX, but everybody covers that, so there's not too much insight when there's that size of a condor. But let's start with that and go from there. So I'll share my screen just a second. So we'll start with this. What we have here is my base. This is like my base one analysis. So what we see here is the purple bars and the green bars are puts and calls, just as the legend says it. The blue is a model that tries to represent the hedging dynamics and forces and everything that DOCS goes through. And you guys probably follow and like, and everybody's into this gamma thing. So not too much to say about this. Obviously, these positions overwhelm everything else. So even if we go past these positions, the drop-off from a gamma perspective is so large that the market will mostly struggle with charm coming from these calls outside of the iron condor range, or if it were to go through the put side, it will have a massive drop in gamma, just as it has on the call side, and then it will be most likely affected by the positive charm coming from these puts, right? So unless we don't have something dramatic early on the day that is able to get out of this range, and the market will pretty much, the price action will be similar to yesterday, meaning that only at the second half of the day we were able to do anything with this call side, and then we just got stuck right at the bottom of the call side versus the remaining calls. So this dynamic might repeat itself. Now, this was the basic profile. What else we can see here? This is a model of expectations. Where does the market where are the highest expectations for the market? So this shows that anywhere between 6,900, 6,915 is the max expectations for the market out of the positions through whatever model I'm using. The reason for that is we can see that the 6,900 being this point here, I'll just mark it. Right, this point here is pretty much from here the model starts dropping off, right, and we totally lose it around this level where this model drops from its value, which is 0.1. Doesn't matter what the value is, but also we can see that the put side also drops from 0.1. So
is that speed? Is that color? How would you describe that?
That's your implied high of day. This
Okay.
shows you the implied max high of day as people understood it yesterday, right? We're looking at data that we get today, but it shows basically the post-clearing process of December 22. So by the time the RTH trading ended, this is what people thought about today, right? And on the put side, they see 68.50 as a potential low of day. Now, obviously, these can be breached. The actual levels.
Let me explain something to the people. So basically, what his method is implying is that beyond those ranges, the rate of change or the rate of acceleration up or down kind of trails off. Is that an accurate way to put it?
Well, the blue line at the main chart shows the potential acceleration of the hedging effect, and we can see it drops off dramatically post outside the range of the iron condor. Obviously, this is pretty logical. The reason for it is just the sheer ratio between this position of the iron condor in terms of open interest versus the remaining out the money calls and out the money puts. That difference is so large. It's like you're able to climb that mountain, right? Drop it off. Now you're on a plateau, but you have no gas. So
Right.
other
And the
than
same thing on the other side.
gamma and charm, nothing will actually move the market unless a long-term investor or something like that comes out and
And the same thing on the other side, correct?
yes, correct. Just a second, please.
So what I want people to take away with is that the rate of acceleration or the rate of change kind of stalls or peaks at those two levels. Not that we can't go past them, but then the curve flattens out.
Right. Now, in terms of the full implied expectations of the volatility, most of you use expected range. This has nothing to do with expected range, this box on the left, top left corner. It might overlap expected range, might not. It has nothing to do with expected range. It's another model I use to, right off the start, basically, because I use the Globex products, right? So I would rather do the ES than the SPX in terms of options. Reason for it that I have 23 hours to react if anything happens, other than, now the SPX does have overnight, but I think it's 18 hours, so 5 hours less than the ES. Anyways, the implied potential of the high of day and low of day are exhibited there. So we have around 69.10, 69.15, between these two models showing up pretty consistent. Downside, we see 68.40 being the level. So obviously this is today, no-brainer here. The effect of the iron condor also affects the implied potential range. But on other days, you might see numbers that might seem, less popular, but they're pretty accurate. Okay, so we did this, and now let me share something else. Just a second, please. So same analysis, but looking at the Qs. The Q has no iron condor. You can see in the money puts being up to 60.20, right? The purple bars are pretty much right now versus the Qs are in the money. You don't have that magnitude of in the money calls from 60.18 and under. The reason I'm bringing the Qs is because here we have information today, and in the SPX we have little information because of that dominance of the iron condor. So I'll start going through the steps of the Qs and tell you what I understand from it. First of all, you can see that different from the SPX, this distribution of the expectations, this chart where I just did the X, is tilted to the right, meaning the expectations for the NASDAQ is actually very bullish, right? They clearly are tilted to the right, all the way to 624, 625. Okay, so this is let's call it evidence number one, right? We have the potential high of the day is around 624. We can see it here where I just marked another X to the left. So top side, there are two models that show potential or implied high of day and low of day. So we have 624 pretty consistent, and we have 613, 616. Let's call it 614 as the downside. Now, as I see this, because it's not symmetrical and tilted a bit to the bull side, I want to see more information about this. So I will load up something else. Let me put it here. Do you see this? These are skews of the Qs. Do you see it? Doc?
Yes, it's on the screen.
Okay. Now, what we're seeing is we're seeing the same pattern. If we're looking at this blue thing without explaining too much what it is, this this blue thing, right? We also see it's tilted from 620, it's tilted towards this side, right? So this is additional evidence of bullishness, and this is actually the opposite of what we saw yesterday. Yesterday we had a clear short signal on the NASDAQ, which turned out to be correct. Right off the open, we got a drop of 200 points and basically dragged the S&P and had that NASDAQ stay there for most of the session. Today is it's different. It's more tilted to the left. This skew is a model that tries to express the potential position from a skew perspective. A bit complex, but this is what it is, from a skew perspective of the market, of the customer's side, right? So what it shows, it's similar to a payoff chart of a bull call spread, right? If you buy a call at the money or near the money and you sell an out the money call, you'll get a payoff chart that looks like this blue line, right? Peaking at your sold strike, and from there it drops to zero and under, and you have that exposure, and you have that drop off to zero. Sorry, you don't have any exposure. It's a one-on-one spread. So clearly, the positions they did by the end of yesterday was a bull spread to the upside, or they did something pretty strange where they bought the at the money, near the money vol and sold the wings. So they sold the puts and sold the calls, and that's why we're seeing some elevation just above the money. The spot closed yesterday 620, so we're seeing some elevation. This looks more like a call spread, but this could be something else. So I'll dig deeper, and now let's check how the position distribution came out. Do you see this screen now with the Excel and all the...
Yes.
So you're seeing the strikes here, and you're seeing some blue and red, green colors here, yeah?
Yes.
Okay. So now what we're seeing is what I think was the side of trades that mostly affected the open interest report. So basically, I'm trying to simulate what will be the clearance of December 22. Now, as we know, there's a lot of volume going on each strike, SPX, Qs, doesn't matter, but there's little change towards those volume generally on the OI, right? Most of the time, the volume is basically day trading, so people buy and sell the options by the end of the day. They don't have a real effect of the OI, but so I try to look through that noise and try to guesstimate the best as I can what from the volume will actually remain into the open interest and affect the open interest report. And I generally get it 90% correct, so it's pretty good. And what we're seeing here is these green boxes and their numbers show puts being closed. That's why this is green. And these orange with the minus numbers show calls being closed. Now, if you look at it, this area is actually the only area that near the money that doesn't have any OI being closed, but rather being bought, right? These are additions to the open interest versus the previous day. For the call side, these are additions for the put side. They're colored green and red just because these are calls and these are puts. But you can clearly see that this section has open interest added versus the wings, right? Versus the wings, which have open interest removed, okay? And this, in my eyes, correlate to the previous chart that showed that there was interest from a skew perspective to have this type of position by the end of the close, which again either is a call spread or a inverted butterfly, meaning you're buying the at the money and selling the wings, right? Opposite to what a butterfly is, where you would sell the strike you want to go to and buy the wings. Here they bought the strike they want to go to and sold the wings. And this, because this hump in the skew is above the spot, it shows interest towards that level.
So if I'm a simple trader, scalper person,
it's not simple, but it shouldn't.
no, I know it's not. That's why I'm trying to make it simple for the people listening. So after this detailed analysis, if I'm a trader saying, Val, that sounds really good. So what should I do?
Okay, so what am I going to do? Based on this data, right? Don't forget that just like anybody else, right? Maybe people were, by the end of yesterday, they were bullish for whatever reason, but overnight things change, right? But assuming they know what they're doing, right? The collective view, they know what they're doing. Based on this, when we reclaim 620 on QQQ, I will be long heavy, aiming towards 625, 626. That's what I'm going to do with the data I just showed. This is how I understand it. Now, because their mind might change because maybe something overnight happened which I'm not aware of in terms of whatever. As long as we don't reclaim 620, 621 on the QQQ, I'm not going to do shit. Only if we reclaim that technical level, then I will match myself towards these expectations. And again, these expectations are bullish, nothing short than bullish, because everything is above yesterday's spot, right? And it clearly shows the blue line an inverted skew, meaning instead of the trough being just like the yellow one, just like this, just like a normal skew you would expect, right? This skew that I just colored green. So you have that natural shape of skew where the trough is always above the spot, right? And the wings are bought, right? That's your natural skew. Now, the blue, which is my model, is clearly a major difference than your natural skew. And it shows that the expectations are above spot into these levels, which are 627, 8, 9, whatever it is, right? And based on this, which I deem bullish, I just match it for risk purposes. I match it with some type of technical level, right? If you open a chart of the QQQ, you could clearly see that the 620, 621 is like a local resistance. We just dropped down from it during the Globex. And if we were to reclaim it, I then flag and say, if we reclaim it, we basically fall into these forces and the market will drift higher about 5 points or so on the Qs. Whenever that will happen today, I will go long for as long as the 620 holds on a 30-minute bar. That's my analysis. Now, reason I'm not looking too much at SPX is because, you know, that iron condor is what it is, and we can only trade once it goes outside. If you're looking for direction, you can really only trade once it breaks out. Otherwise, you're just there in the middle of those forces. But
Okay,
the
let me answer
Q
this.
is totally something different, clear information, which is pretty rare. That's why I'm sticking to the Qs.
Okay, let me answer this person's question. So Val Trader is part of the community. He's a friend, and he puts in his analysis in the community during the day. Yesterday, we were looking at charm and stuff at the end of the day. So yeah, he's part of the community. I want to switch. First, I just want to show you guys what happened while Val was explaining the QQQs, and we had a little pullback right here into the stall area, right near 6860 equivalent, which is kind of where we get into the orbit of the IC Wales puts. The puts are at 55. It kind of came down here. And then we got the market maker reflexive response, which brings me to over here. So here's where the customer short, market maker long puts are. So as we know, as we go down, market makers have to buy. So as we get into this area, they have to start buying. A little bit of a notch here at 70. So there's this 70, 68, 70 stall area here. So here's kind of a clumpy area between 60, 70 with the 55 being the line in the sand, or 50, call it. I have 70 or 75, depending how you want to look at it, as the inflection point. If we can get over 75, call it over yesterday's close. There's a path up, maybe 10 points to 68, 85, maybe a little higher. Then we get into the range of this, where as we go up, they sell, but as we go down, they buy. And you just kind of get caught in this Greek dance of where the volatility is, or where the positioning is, or where the volume is. That kind of pushes it, tilts it toward one side or the other, assuming we stay in this range. Assuming we stay in this range. Now, let's just stay with this range for a second. If then, right, conditional, path dependent, if we are just, let's say, 68, 90-ish, and it's near the end of the day, then this becomes sticky. As we go up, they sell, but then as we go down, they buy, and we get stuck somewhere near 6,900. Could we overshoot a little bit and be here? Sure. Not likely, but we could. And then as we move away, then all else being equal, they have to buy. On the other hand, same story, different time frame, same time frame, different story. If we're down here 65, 60 toward the end of the day, as we go down, they buy, but then as we go up, and we can get stuck. So we could get stuck to or pin within a few points near these big levels, all else being equal. I want to show you something else. This view just helps look at the relative magnitude here. So here's 40,000. Hopefully you can see it. Let me make this a little bigger. See, I'm getting fancy here. Okay. So here you see, here's the IC Wales calls. Above it, we have more customer sold calls, market maker long. So this mutes the move up. So here we could get up through here, but there's not a lot pulling us up after that. So we probably get sucked back down here. You have something over here. This looks like the opposite side of the spread. On the other hand, okay, so here's that 70 I talked about. 2,900, that matters. Not that much compared to these. But remember, this is basically hedged out. And this still needs to be so this is going to need to be dealt with. The 60s need to be dealt with. So this kind of creates a little range within the range, 68.60 to 68.70. But BUTT, if we break below the 50s, the 55, 50, 68, 50 round number, and we also say some people in his service do 10 wides. So call it 55 to 45, stall at 40, which Voltrade also had as a level, stall at 40, but we have a little bit of stuff here at 68.30. We have a bunch of stuff here at 68.15. So the risk, so to speak, is skewed a little bit to the downside. Not saying we break, not saying we go down, but the risk is skewed that way. On the other hand, again, I got a lot of hands. You're lucky. On the other hand, this provides a little potential decay, not that much because it's a little far away. And so that's kind of where we are. I want to show you one more representation of the same thing.
I want to add something after you're done, okay?
Okay, sure. I'm just gonna tighten in the time frame a little bit and the levels. This was, I showed you this in the Substack note with my little arrows, but let's see what we're looking at here. The blue is where market makers are long. So they're buying the dip, selling the rip, we're bouncing around. And so you could see almost wherever we are, whether we're at 68.90 or 68, 70, 80, anywhere in this range, it's positive gamma, quote unquote, market makers are being supportive. Once we fall, if we fall down in the 60 area, especially early in the day, kind of the white pale implies market makers kind of have their hands off, so to speak. And so the potential, especially earlier in the day, if we get down below 50.45, is this kind of, you can get pulled into this area. It doesn't mean we can't get back up. So a better convexity play might be, if we can break here, which I'm not sure that we can, something heading in that direction. Maybe a 50 something or I don't know, we'll look at modeling out a trade later. On the other hand, getting up above 6,900 is just going to be hard. We got blue all over the place. So wherever we go, market makers are going to be selling, but buying, supporting. So as long as we're in this 70-ish zone, even in the morning, there's some kind of support, sticky stall. Hey, the market's not going anywhere, scalpers complaining kind of thing.
Can I go ahead?
Let me see if there's anything else I want. Okay, one last thing real quick. So you guys knowing me, what did I do? As we pulled back, I sold just 5 ES put credit spreads just because I can't help myself. I'll do my usual, especially this account, which I don't pay much attention to. Profit target. Let's see what 70 cents gives. 15 cents by the close. Goodbye, and then I'll just wait for it to go bye-bye. We'll look at other trades and stuff like that later. Go ahead, Val. You wanted to say something? You had to share the screen you wanted to share, or?
Yeah, I'll share the screen again. 1 second. Just tell me when you guys see the Excel. I think you need to do something on your end so I'll be able to show my screen.
Okay, let me get it. There you go.
Okay. No? Okay. So do you guys see 2 charts on the left?
Yes.
Okay. So what we're seeing here now is, again, this is SPX, back to SPX. My model shows a massive plateau starting from 68.80 or so, all the way to 6,900, 6,915. This indicates a tilt of call selling within the iron condor and up to 69.15. Right now, the reason people would sell that is because they don't think there's upside. Upside hedging starts 69.40 from a customer perspective. And so this is pretty muted and actually a bit bearish because they chose to sell more of the call side area of the iron condor rather than the put side. You can see that into the put side, the skew is starting to rise, right? Indicating that just like they're starting to hedge the upside 69.40, against their short call position, they have downside hedging starting just before the put side of the iron condor around 68.70, 68.65. Now, let's see if I could identify something that supports that. So either I want to see activity in the call side, 6,900 and over, or some activity in the put side, 68.70 and under. I'll just strafe to the left, to the right, and here I have my model that tries to understand what the volume yesterday did in terms of open interest. And what I see here is that the call side has negative numbers, only the call side, indicating that they probably sold in the money calls, right? Much more so than they did anything on the put side. You can see the put column, which is this, being pretty pale other than the highlights of the iron condor, whereas the call side has a lot of activity indicating selling in the money calls, which is the equivalent of buying, well, not exactly, but it's more bearish than bullish. So that would explain the skew showing that the put side is more heavily hedged versus the call side. So from this perspective, I'm aligned with Paul that said there's a little bit tilt to the downside. I can also see it from my models, pretty clear. So this means that now the selling starts 68.50. So I want to see if I can find a transition around that level, and I can. If I go to this model basically does something else more from a directional point of view, and it clearly shows that these dotted lines cross from bullish being positive value, this area, and bearish being this area. And we can see the cross around, this is 0 here, right? We can see the cross of these dotted lines happening around 68.50, which pretty much correlates to those in the money calls being sold up to 68.50. So everything from 67.80 up to 68.50, we had calls, in the money calls being sold by the end of yesterday. If we look on this side, this table basically tries to tag every level similar to how Paul does, and tries to tell me what to expect from each level. So we can see obviously the iron condor being the main levels, but everything else is pretty muted or unresolved by this model. This means that if we were to drop 68.50, there's nothing here that can do anything meaningful towards if we lose the 68.50 on the SPX, right? So I don't know if that will happen, of course, but we did get some weakness from the Qs coming in pre-market with this big drop that we just had now on the 30-minute chart. After it failed to take out the 68.20, that's my bullish level that we spoke about before. That pulls down the SPX, which had a big bar 30 minutes ago, coming from 68.75 and dropped pretty fast to 68.60. And now we're starting to negotiate with this 68.65, 68.60. We're still within the iron condor, but obviously this seems they want to tag the lower edge of the iron condor. And if we lose the 50, if we were to lose the 50, which doesn't seem to be the case, we then go into that bearish phase that I just explained.
Okay. Thanks. Let me get back to what we're doing here, because it's already 9:20. So let me share a screen with some trade ideas. real quick. And we're still kind of weakening. So let me take a quick look. So yesterday, in response to the IC whale trades, I tend to like to go just a little bit further away and a little bit wider and basically use him as a blocker. And here were some trades I had done the day before off of that. And so here's what we did yesterday, and then we'll look at what to do right now. And so on the put side is kind of getting a little toasted. So his 68.55s are getting really toasted. We'll look at those in a minute too. The calls are clearly okay. I'll probably just close out the calls. Not probably, definitely. Just close out the calls. Now the whole line counter is just down, is basically flat. But it's just easier to manage for me. I'm just going to close this out at the open. I'll give them their 10 cents. Buy one of them. And I'll buy one of these back. What's my 50% profit target? I'll kind of use that as a guide. Buy one of these back, close position, 50% times 1 at a quarter. At this stage of the game, I'll be happy to get out. And what am I going to, now I still think this is safe. This is your 20 delta. This is your expected move. So if I can duck below that, 68.15, 6,800, let's say, for a starter, wow, decent premium even there. I like that. I'll take that, add to it if I can get it. On top right now, there's no easy trade. Maybe there's 69.05 or 69.55. I'll try that for 40 cents. See if I can, whoops. See if I can get
the reason there's no meat up there is because they're selling those calls. Yeah, they're squishing the call wing skew.
Yeah. See if I can get 50 cents for those. Now, in terms of getting a little convexity out of this, see, I always like to play with the flies, butterflies. So let's get started with a call fly and see what we can see. So this is kind of where we close. We expect stalling around 6,900. 80 cents to stall there. I want to get a little convexity on the move up. Let's see what an 85.90. Well, I got all these positions here, so it's kind of a little hard. Okay, that looks decent. $1.20. I'm not crazy about that. So because I have this stuff here, it's hard for me to put in a trade that I like. I don't see anything great with what my positioning is here. So I'll just do something a little more simple. Let's just move it up a little bit and widen it out a little bit. That's not bad. I'll take that for $1.30. 75, 85, 95, basically at the money. So all we need to do is get moving a little bit and we're okay. On the put side, okay, so let's put another put go. On the put side, let's move the strikes down. Here's where we get the acceleration, right? So if I go 50, let's see what 60, 40, 50, $1.45, that's too expensive considering we have maybe asymmetrical like that. Well, the numbers have dried up. I might look at something like that, broken wing or asymmetrical. Anyway, it's 9:25, so I'm gonna stop. Yes.
Talk to you later. Bye-bye.
Yeah. My daughter is here visiting,
Thanks, Vol Trader.
and she's
Bye-bye.
He's going to the gym downstairs. I have a little gym down in the basement. Okay, everybody. Oh, one last personal announcement, in a way, very personal. I'm having a test tomorrow that requires, let's just call it a GI test. So I'm going to be indisposed later in the afternoon, having to be near a receptacle. And tomorrow I'll be going to get my GI series. And so I'll probably be unconscious most of the day with the shortened trading day. Knowing me, I'll try to do something right before I go under anesthesia. I'll put a trade in, or I'll put an idea in. I'll try to write something up at 4 or 5 in the morning, whatever, and that's that. So anyway, thanks for listening. Richard, any closing comments?
I wish you the best with what you're going through tomorrow. And I wish everybody a very happy holidays. I'll be out by about noontime today and kind of on the fence about Friday. But most importantly, you be well, take care of yourself, and I hope everything goes well.
Yeah, thanks. It's just a test that people of a certain age need to get with certain regularity. That's not pleasant.
Regularity, no pun intended. All right. Good luck today, everybody.
All right. Take care, everyone.